Let's dive straight into this explainer. Today, we're popping the hood on the modern bank, breaking down Morad Chowdhury's essential text, The Principles of Banking. We all interact with banks pretty much every day, right? But how many of us actually understand the massive, incredibly complex engine operating just behind that ATM screen? Well, let's explore this together and deconstruct exactly how that machine actually works.
To kick things off, I actually want you to think about the sci-fi epic Dune. On the desert planet of Arrakis, the Fremen fiercely preserve every single drop of moisture they can. To them, water is literally the difference between life and death. They call it the water of life. Chowdhury makes this brilliant comparison to our financial system. Because for banks, liquidity, which is just the continuous availability of funding, is absolutely their water of life. Without it, the entire system just collapses.
So here is our schematic for the day. We're going to cover 1. The business of banking, 2. How banks make money, 3. The capital cushion, 4. The two books, 5. The money markets, and 6. The liquidity tightrope.
All right, starting with part 1, the business of banking.
This entire multi-billion-dollar industry really exists to solve one fundamental problem. The economist John Hicks called it the constitutional weakness of financial markets. Here's the rub. Lenders, like you and me putting our savings into an account, we want to invest short-term. We want to be able to access our cash whenever we need it, right? But borrowers, like a family buying a new house or a corporation building a massive factory, they need long-term funding. They literally cannot pay back a massive loan tomorrow. So banks exist as the ultimate intermediary. They sit right there in the middle, perfectly reconciling the needs of cash-rich lenders and cash-poor borrowers.
And a bank pulls this off because of its massive, diversified balance sheet. They pool all these different risks together across a huge scope of activities. You've got retail banking handling your everyday personal loans and deposits, right alongside massive commercial lending, private wealth management, and high-octane investment banking. By diversifying across millions of everyday customers and thousands of businesses, the bank can safely transform those short-term deposits into long-term loans.
Moving on to part 2, how banks make money.
Let's see how translating all that risk actually turns into revenue. What's really fascinating here is how fundamentally different these institutions can be based on their business model. Take a traditional UK building society. It relies on a whopping 80% net interest income. That is your classic model of borrowing cheap and lending at a higher rate. But then compare that to a US investment bank, which generates 52% of its revenue from face and 26% from highly volatile trading profits, with very little reliance on traditional interest. They are completely different beasts, yet they both operate under that same broad umbrella of banking. Now, for your average retail bank, the core operating income breakdown usually leans heavily into net interest income. It's the undisputed king, often making up around 64% of the pie. So it's absolutely crucial to understand what NII actually is. Very simply, it's the core yield a bank gets from the loans it makes, minus the cost of funding those loans. And you know what their absolute favorite, cheapest source of funding is? Your retail deposits. Yep, the money sitting right now in your checking account, earning near zero interest, is the incredibly cheap fuel that powers this massive slice of their revenue.
Okay, part 3, the capital cushion.
So if a bank is lending out all of this money, what exactly happens when borrowers just don't pay it back? To protect this lending engine from a total catastrophic collapse, the bank needs defensive armor. And we call this bank capital. It's basically an equity buffer designed specifically to absorb unexpected losses so the bank doesn't immediately go bankrupt. Now, there's a super common misconception that banks just lend out their own money. They absolutely don't. A bank's actual equity base, its own capital, is remarkably small, usually only around 8% to 12% of the whole balance sheet. They take that tiny amount of equity and leverage it up 10 or 20 times over with borrowed funds to run the machine. Because that capital base is so small, regulators are obsessed with its quality, dividing it into strict tiers. Tier 1 capital is the gold standard. We're talking core equity and reserves. It is completely non-repayable, meaning it's permanently there to absorb losses without ruining the bank's reputation. Tier 2 capital, on the other hand, is lower quality. It's made of things like subordinated debt, which is shorter term and eventually has to be repaid. Regulators watch the ratio of these tiers like hawks, just to make sure the bank's defensive armor is actually robust enough to take a real hit.
Which brings us to part 4, the two books.
Inside a bank's internal accounting structure, it basically splits its personality into two distinct halves, the banking book and the trading book.
The banking book operates on a strict buy-and-hold philosophy. It holds on to long-term traditional loans, like your 30-year mortgage, and uses accrual accounting, which just means it records revenue as it's earned over time, rather than when the cash actually moves. The trading book? That is a completely different world. It handles wholesale market transactions and derivatives for short, quick bursts, usually well under 180 days. Crucially, the trading book is mark-to-market daily, meaning its recorded value fluctuates every single day based on current market prices. This strict separation is vital for how a bank measures its risk day to day.
Let's move to Part 5, the money markets. If the bank is the engine, the money markets are the vital plumbing connecting everything together. The money markets are where short-term funds actively flow between the players who have extra cash and the players who desperately need it. In this world of indirect financing, you have brokers who simply connect a lender and a borrower for a fee without taking on any of the risk themselves. But then you have dealers or market makers. These guys actually take cash positions directly onto their own books to quote two-way prices. The dealers are the ones actively absorbing the risk to keep the entire market moving smoothly.
So the flow of funds through this massive secondary market generally follows three pretty simple steps. Step 1. Cash-rich entities supply the short-term funds. Step 2, banks and intermediaries pool all those funds together. And Step 3, cash-poor borrowers receive that capital for long-term investments. And you know what drives the pricing of this entire massive flow? Government treasury bills. Because they are backed by the government, they carry the absolute lowest default risk, which provides the risk-free benchmark interest rate that literally dictates the price of everything else in the market.
This global structure is essentially an incredibly interconnected web, linking central banks, commercial banks, securities houses, and the government. And it relies entirely on standard global conventions to function. We're talking things like calculating interest on a 360-day year, or using benchmark interbank rates like LIBOR or Euribor, which are just the average interest rates major global banks charge to lend to one another. These conventions are what keep trillions of dollars moving without a hitch. If even one single node in this system freezes up, the entire plumbing backs up.
Finally, Part 6, the liquidity tightrope.
This right here is the ultimate balancing act that defines whether a bank survives or goes under. The central risk in all of banking is known simply as the gap. This is the stark difference in maturity between a bank's liabilities, which are short-term, like your deposits that you could literally withdraw at any second, and its assets, which are long-term loans that won't be fully paid back for decades. This maturity transformation contains a massive, explicit assumption. The bank assumes it will always be able to roll over its funding as it becomes due. It essentially assumes it will always be able to find enough new cash tomorrow to cover the withdrawals of today.
To survive this crazy tightrope walk, Chowdhury lays out some fundamental, highly conservative principles. Secure your funding base before you lend. Establish core, stable customer deposits. Lend prudently with sound judgment, and always maintain a strong equity capital cushion. And remember, this isn't just some abstract high finance concept. Those core, stable customer deposits, that's your money. Your savings account is the very liability that keeps this massive machine running day in and day out.
Which brings us right back to where we started. Liquidity really is the water of life. Because during a crisis, that continuous funding can just evaporate overnight. So I want to leave you with this final, provocative thought. When that core assumption of continuous funding fails and the water of life completely dries up, is our global financial system truly built in a way where these banks can survive without falling back on the taxpayer to bail them out? Think about that the next time you tap your card. Thanks for joining me on this explainer, and keep questioning the systems around you.